All right, here in chapter six, we're going to tackle a really, really difficult, challenging conceptual concepts of inventory and cost of goods sold. You will want to absorb all the videos, information that you can, watch these, watch additional those YouTube videos I've posted, read this material, think through it. It is not super intuitive. There's a lot of nuances to it. So buckle in for this material. All right, so reporting inventory and cost of goods sold here in this first part. We want to think about inventory system from different types of companies. We've mostly been talking about service companies providing a service. There's not real inventory to worry about, maybe some supplies, but it's just I'm doing something that's of value to you, so you're paying me for it. But when we think about selling something, either a good, a phone, or a car, whatever, we didn't get that for free. We got it somehow. It cost us something. It's an asset. We sell it, and what do we do with that stuff? So that's what we're getting into. That's the frame of reference here. So inventory is just items for sale. It also includes items that are not yet finished. So if I'm a manufacturing company, I'm in the process of making a car at the end of the period, am I not going to consider a car that's, it's 50% done as inventory? Well, I need to account for that somehow. So that's in process inventory. And then the finished goods that we finished them before the end of the period and they're for sale, they just haven't sold yet. What do we do with that? Okay, so here's an image of this. So inventory can come from two places: a manufacturing company that makes the cars, per se, and a merchandising company that sells the cars only. Right, so the manufacturing company will mostly focus on raw materials, the work in process, the finished goods, and the merchandising company can either be a wholesaler or a retailer, right? And tracking inventory both ways. You can already see it's like, oh my gosh, this is a lot of things. It is really, really, it's tough. Absorb all the information you can on this. So for comparing here, manufacturing versus a retailer, Intel makes the chips, computer chips and stuff. They'll have the raw materials, the silicon, the parts, the plastics, whatever, the work in process, so all the chips that they've got that are in process and other things they make, right? And this is in millions, so that's big numbers. And then finished goods that they've got available. So that is their total inventories. All of that represents inventories to them. And then for Best Buy, they don't make any of those things, but they have merchandise inventories available for sale. So it's all inventory, just different types of inventory that are appropriate for the different type of company. So key point here, service companies record revenues when providing services to companies, mostly what we've been focusing on. And the merchandising and manufacturing companies record revenues when they sell inventory to customers. And certainly a company could do both. Best Buy now through Geek Squad, they have that service component, right? So they're trying to branch into other types of revenue generation models in addition to just inventory. But so it doesn't have to be all one or the other. Okay, so let's look at different types of companies and kind of the flow of this. For manufacturing company, now putting some pictures to this, raw materials, the labor of people and machines, whatever, making things, the overhead, called selling general and administrative, SG&A expenses is all part of overhead. The work in process of things that are not quite ready to be sold yet, and then the finished goods that are ready to be sold. Merchandising companies, again, um, like Best Buy, all they're doing is selling this material, merchandising company, and then the end user service company, providing service, training on how to create a website or something. That's where their revenue generation is from. Okay, so how is cost of goods sold reported in this multi-step income statement? All right, so relationship between inventory and cost of goods sold in the beginning inventory, it's an asset, plus the purchases during the year, also an asset, 20 plus 90, total inventory available for sale, $110,000 or in millions or something. Now the inventory that is not yet sold, our ending inventory, this is an asset in the balance sheet. Here's what we've got available. But the inventory sold, the component of that is remember, we didn't get it for free. It didn't come out of nowhere. We had to acquire it somehow, either make it or bought it. and there is a cost of that good sold. It is a beautifully, wonderfully accurate description of what the thing is. It is a cost of the goods sold. What did those things cost that we sold? That is an expense in the income statement. And the key point here, the inventory, it's a current asset because we're expecting it to be sold in the current year. Even if it's not, it's a reasonable hope and expectation, part of our business, that it will be sold in the current year. So it is a current asset, or within, this a rolling 1 year period. And the cost of goods sold is an expense reported income statement and represents the cost of that inventory sold. Okay, so here's what this looks like. Let's take a deep breath. Multi-step income statement here showing different levels of profit. So all the revenue we've sold minus what we just looked at in the last chapter, net of these contra accounts, returns, allowances, and discounts. And here's that new term, the cost of goods sold. What did it take us to, how much did those things cost us that then we sold? So that's our gross profit. And gross just means the big number, not you, but the big number, that 10,048 in millions. And here's that SG&A expenses, selling, general, and administrative expenses, advertising, salaries, rent, utilities, everything, right? All those expenses. So this is our operating income. Is this level or operating profit, right? But we'll call it operating income. And then other income, right? Things that we might see from um, investing activities or investing activities primarily, and then other types of less common things, right? Gain on a sale investment, investment income, interest expense, just other things. And this will be income before income taxes. Companies like to report this number as well. And then income tax expense to get all the way down to net income. Okay, and then there's a note here. There could be other things, but that's for way down the road. Okay, so different levels of profit: gross profit, operating income, income before income taxes, and net income. Oh, some key points here. Multi-step income statement reports multiple levels of profitability, and we've talked about each of those. Okay, so determining cost of goods sold and inventory using different inventory costing methods. So we get that there's different for each company, they're reporting inventory in different ways. So we're going to look at appropriate ways to account for and create and recognize the cost of goods sold depending on the cost of the inventory. So there's 4 ways we're going to look at. One is a specific identification. Think about automobiles, matching each unit of inventory with its actual cost. What did this vehicle cost? Look up the VIN number. We could see if a company were using this method, we could see exactly what it cost. For FIFO, first in, first out, think milk. So this is a milk refrigerator case where they load it from the back, right? And they keep pushing the oldest milk up to the front. So the first milk in is pushed up to the front, is the first milk sold, so that you're always you're actually buying the oldest milk available for the store. But from an inventory perspective, if the milk is going to last maybe 3 weeks or a month at the store, probably 2 to 3 weeks, they want to sell the oldest stuff first so that what they have, their inventory doesn't go bad. And what you have, you still have a week or two to drink that milk, and it still tastes good. So for FIFO, think milk. That's the type of asset that works well for. For LIFO, think a large pile of sand. So down by the river in the Tulsa area, Bixby, there are sand and gravel companies that harvest raw resources from the area around them. Also going to like a landscaping company, you might see large piles of non-perishable goods, sand, gravel, other types of maybe mulch or something. So the last stuff in is the first stuff out, right? It is not practical to think that they could get the oldest sand from this pile, right? That's just that doesn't make sense. How can they get all the way to the bottom and pull that stuff out? That does not make sense at all. So for LIFO method, last in, first out, think sand pile and selling the newest stuff first. Weighted average cost, think a clothing store. I think this is probably from Kohl's. Um, all these things, you coming in and out, this season, last season, marked down things, new things. They definitely cannot use specific identification. It's non-perishable in the milk sense. It's not perishable like that, but it's also not going to be there forever like sand or gravel. There is a, a fashion sense and a season sense. So a weighted cost average makes the most sense for clothes. Okay, so there's four methods, and we're going to take a closer look at each one right now. So you're going to use example for a Mario's Game Shop. So they might sell board games, video games, other types of games. Okay. And their costs are rising. What it costs them for their inventory is rising over time. The beginning inventory that they have, it was created, on December 31st, it was the ending inventory, but now on January 1st, it's the beginning inventory. They have 100 units of games, and it cost them $7 per game. Okay. So they might resell it for 9, 10, 12, $20, whatever they can get away with. Right. But it cost them $7. And so their Mario's internal inventory cost for that beginning inventory is $700. April 25th, they purchased 300 additional units, costing them $9 per unit. So their cost for that inventory, $2,700. October 19th, they purchased an additional 600 units, and the unit cost is $11. So we see rapid unit cost increase, probably not realistic. It would be, I mean, hyperinflation to almost double. That's a good, yeah, a good 50% increase in 10 months. That's rapid increase. Showing it just to really highlight the unit cost increase, not that it's realistic, but just to really highlight that over time, the cost for companies to purchase their inventory does increase over time. All right, so their total cost there. Add up these numbers, $10,000 for 1,000 units for sale. July 31st, so this number be right in here. They sold 300 units. December 15th, they sold 500 units, right in here. Total units sold of 800 for an ending inventory of 200 units. Started the year with 100, bought some stuff, sold some stuff, and with 200. Okay. So if we're using specific identification, those actual units sold, if we're using that example, and think cars for specific identification. If Mario is using the actual units sold, 100 units at beginning, 200 units purchased, and 500 units purchased in October, the cost of the units would be reported as the cost of goods sold. What did it cost us for the goods that we sold? Beautifully descriptive term. I love it. Now, the cost of the 200 units remaining consists of 100 from the April 25th purchase and 100 from the October 19th purchase would be reported as ending inventory. How did we get there? So we had this 400, right? Beginning plus the purchase. We sold 300, so we had 100 left out of this batch. And then from this 600, plus what we had on stock, there was 500 sold. That gives us the additional 100 left over. It's just not practical for most companies. Like that's a lot of units. Most primarily used with companies with unique, expensive products, low sales volumes. So this is an image of a Ford F-150. They sell lots of those. Probably even like a Rolls-Royce, right? Or a Ferrari, Lamborghini, something where far fewer items are sold. Could be an even better example of specific identification. But whatever it is, think. Unique, expensive products, low sales volume. Okay. All right. Now the next three are far more commonly used FIFO, LIFO, and weighted cost average. Each of them assume, as we thought about for milk, sand, and clothes, a particular pattern of inventory cost flows, of how does the inventory move through the store. Key point here, the actual reality of inventory does not have to match the assumed cost flow in order for the company to use a particular method. Okay, so they're allowed to use any kind of inventory reporting they want, even if it doesn't match the actual flow. This, I think, concession from um, from FASB and partially from the IRS is a little bit odd, and it doesn't fully align with the principles that we've been talking about of making sure that investors and creditors really have a clear picture of what has happened, how it's happened. But it was a decision. I'm sure there were hundreds of hours of discussion on this rule. But just keep in mind, for however it ended up this way, that the choice of inventory accounting method does not have to align with reality. Okay, just hold that in mind. Okay, so let's look at each of these. For FIFO, again, think milk, first in, first out. The oldest stuff is being sold first so that it can all stay fresh and be consumed in a reasonable time. Okay, so if we're looking at Mario's Game Shop again, using the FIFO method, that milk method, we're going to keep things fresh. Probably not as, yeah, it's not really the fresh need for this, but it's just the accounting method we're using. Again, it doesn't have to align with the actual reality for them. Okay, so same numbers. January 1st, 100 units, $7 a unit for $700. April 25th, $9 a unit, 2,700. Number of units sold 400, cost them 11 there. And at the end of the time, we have just 200 left, saying that the total cost is those the ones we have remaining, because the oldest ones have been sold first in, first out. So the $7 unit items, the $9 unit items, and 400 of the $11 unit items have been sold. That first 800 have been sold. So what's left is our 200 units of $11 unit cost items for 2,200 bucks. Okay. So the cost of goods available for sold is still that $10,000. And the cost of goods that we actually sold, according to the FIFO method, is $700 here, $2,700 here, and $4,400 here for $7,800 of cost of goods sold. And our ending inventory, or the cost of goods available for sale, if you want to think about it in the inverse of cost of goods sold versus cost of goods not yet sold or available for sale, ending inventory is $2,200. Okay, so that's according to the FIFO method. Common mistake when using FIFO is forgetting to count the beginning inventory as a first purchase. So have to remember, we don't, except for when the company is very first starting, but all the examples and things I think we'll have are, there's some beginning inventory. So don't forget to include that in the inventory counting period. Okay, next, LIFO. Again, we're thinking sand. So last in, first out, the newest sand on top is the stuff that's going to be sold first. It makes beautiful sense for reality. But again, do they have to use what aligns with reality? No, they do not. So what's Mario's Game Shop look like in this case? Same purchase items, $7, $9, and $11 units sold. But now we are going to count the last units sold. So the $600 of the 11 unit cost items and 200 out of that 300 batch, we're going to consider these were the ones that were sold. It's still that same cost of goods available for sale. That didn't change, but the cost of goods sold is quite a bit different, right? 8,400 instead of 7,800. Okay? And if this is in millions, that's a big chunk. According to the FIFO method, the milk method, 8,400 cost of goods sold, resulting in ending inventory. So counting these items, the oldest items left, the oldest sand, the oldest games, whatever, in terms of the cost. Ending inventory is 1600, right? Common mistake with LIFO. Um, yeah, it is odd that companies can use an assumed amounts instead of actual amounts. But again, it's just a practicality, right? It's very difficult to keep track of the specific, very specific things that were sold, like in that specific identification method. Nearly all companies actually sell inventory in FIFO, but for various reasons, we use LIFO. We'll see later why. Okay, Waveco, or the weighted average, think close. Again, with all the different, incoming close, outgoing close, and when it's sold and seasonality and all that stuff, they're just going to keep track of an average method. So under this method, we assume both the cost of goods sold and ending inventory consists of a random mixture of all the goods available for sale. Fourth close is probably very accurate. Each unit of inventory has a cost equal to the weighted average unit cost of all inventory items, and the calculation is cost of goods available for sale. So that's that total inventory available for sale divided by the number of units available for sale. Much more practical to count the number of clothes rather than keep track of every single item of clothing. Okay, so Mario's method, same purchases, 100, 300, 600, same costs, same cost of goods available for sale, 10,000 or probably 10 million or something. So the weighted average unit cost then takes 10,000 as the cost of goods available for sale divided by total units equaling $10 per unit. So we sold 800 units. So the cost of goods sold is 800 units sold times $10 or $8,000. Ending inventory 200 not sold, that same $10 price for $2,000 ending inventory, resulting in that same $10,000. So a common mistake here in calculating the weighted average cost, make sure to use that weighted average instead of a simple average. Yeah, so the weighted average, right? Not just a simple average. So simple average of these amounts is 7 plus 11. I'm sorry, 7 plus 9 plus 11 divided by 3 is 9. But it doesn't take into account that there were more items purchased at $11 than at 7 or 9. So use the weighted average. Take the total cost of goods available for sale, 10,000, divided by the total number of units available for the weighted average of 10. Okay. So we're not just averaging this, we're averaging the result of buying however many units at those prices. So these larger numbers include the weight of how much was sold, right? That 10,000. So it gives us that $10 instead of 9. That is a very easy mistake to make, weighted average. Okay, so comparing these three costs then, so taking a snapshot of each of those costs, beginning inventory, there's 1,000 units for sale. In reality, we're going, depending on which way we count it, it's going to give us different results. So it's inventory beginning of the year, it actually did cost us $7 a unit. That first purchase actually cost us 9. Second purchase actually cost 11. That available for sale. Now, what do we do with it? Under FIFO, the milk method, first in, first out, the oldest stuff is being sold first. We're selling all of those $100 or the $7 units, all of the $9 units, and some of the $11 units. For our ending inventory is only those $11 units, cost of goods sold versus ending inventory. Under FIFO, the sand method, the newest stuff being sold first. We're going to work backwards. So we're selling all of the $11 unit sand, some of the $9 unit sand, right? So the ending inventory is the rest of that $9 unit sand, plus all of the very oldest stuff we had for ending inventory of 16. And the weighted cost average, we saw the formula there, 800 units available for sale at $10. Um, an item, oh, I'm sorry, not available, like 800 sold, apologize. 800 units sold at $10 a piece, ending inventory of 200 times $10 for that ending inventory of 2,000, right? So we see, depending on the method, and again, think millions, this could have a dramatic difference on financial statements. Okay, so 3 different methods. Let's summarize this here. It's a common mistake. FIFO and LIFO describe more directly the calculation of cost of goods sold rather than the ending inventory. Ending inventory is just what's left. They're really trying to capture what was sold. For example, FIFO directly suggests which inventory units are assumed sold, the first ones in, therefore used to calculate cost of goods sold. And it's implicit under FIFO that the inventory units not sold are the last ones in, used to calculate the ending inventory. So key point here, companies are allowed to report inventory cost by assuming which specific units of inventory are sold and not sold, even if it doesn't match the actual flow. So FIFO, LIFO, and weighted cost average. Okay, so the choice now of inventory reporting methods, FIFO, milk, LIFO, sand, LIFO conformatory rule. This is the wackadoodle thing. So we have that FIFO method. It really matches reality for most companies. The oldest stuff is sold first. Ending inventory reflects the current cost of what's on the goods available for sale. Thought of kind of as a balance sheet approach because it has a more accurate balance sheet method. LIFO method, the sand method, cost of goods sold reflects the current cost, right? Of the newest stuff we got in, we sold first, right? So what did it cost us? Thinking more about the net income approach of what it cost us and what we sold it for. So because of that difference, there's something called this LIFO conformatory rule that is just like, what on earth? It's nutty. Companies that use LIFO for tax reporting must also use LIFO for financial reporting. So you can't get the best income statement using LIFO and then switch to FIFO for balance sheet to get the best looking balance sheet. If you use LIFO for tax reporting, you also have to use LIFO for financial reporting. Okay, so here's comparison of the two when costs are rising. Ending inventory FIFO and LIFO. And we just calculated these, so it's this weighted between FIFO, LIFO, and weighted, right? The sales revenue, if we sold all of them for $15, we had the same sales revenue for all of them. And that's a nice assumption here just to illustrate the differences. The cost of goods sold that we just calculated is different in each case, resulting in gross profit differences between each one, right? So the choice of the inventory method, and it's the same games. The only difference is how we accounted for the cost differences in calculating inventory and the cost of goods sold. So the choice of the inventory method affects the reporting ending inventory, the asset, and the reported cost of goods sold, the expense and profit. So it's a really important choice and a really big decision for companies. Fortunately, and we'll talk about later, they cannot change back and forth every year. They have to pick a method and stick with it until there's a major reason for change. So we're learning about all of them and the fact that they do have a choice, but in reality, the company you work with, they're going to use one of these methods and probably not change it while you're there. If they do, it'd be a one-time change. Okay, so why choose FIFO and the milk method, oldest milk being sold first? If they want to choose an inventory method that most closely approximates its actual physical flow of inventory, then choose FIFO. Another reason is for its effect on financial statements, right? During the period of rising costs, as we saw with Mario, went from 7 to 9 to 11, FIFO results in higher ending inventory and a lower cost of goods sold because the older stuff that cost less was sold. It's a lower cost of goods sold, which results in a higher profit, right? If the cost of the goods sold is lower, sold it at whatever price, then it indicates a larger profit. Okay, so that's one reason to choose, or some reasons to choose FIFO. Why choose LIFO? Newest stuff being sold first, that newest sand being sold first. Primary benefit is for tax savings. So LIFO results in the lowest amount of reported profits because inventory costs are rising. So we're reporting a higher cost of the goods sold because it's those $11, those most recent units that were sold. So that lowers our net income, right? We're selling at that same price at 15 and we sold all the 11s. So it makes it look like our net revenues, net profit is smaller and less taxes. Okay. So can they do both? Can they have FIFO for financial reporting, LIFO for tax returns? No, as I mentioned. So something called a LIFO conformatory rule. Use LIFO for tax, also have to use LIFO for financial. But, and this is the like next level noodler, just like, oh my God. Do you have to report the LIFO difference? The choice between FIFO and LIFO results in different amounts of ending inventory and balance and cost of goods sold income statement. So companies that report using LIFO, last in, first out, so SAND method, must also report the difference between LIFO and FIFO. That difference is called the LIFO reserve. What? So if they get the benefit from LIFO, they have to show what it would have been under FIFO. So if you work at a company that uses LIFO, you're going to have to calculate it under both ways. So you're not getting off the hook. You still have to learn and be skilled in inventory reporting for both ways and shows as the LIFO reserve. So what's that look like? If Kroger were to use a LIFO um, method, they'd show FIFO inventory with the LIFO reserve, resulting in this current net assets. It's like, oh my goodness, why on earth would they do that? Just again because um, that the LIFO creates better tax advantages, right? But we still want to have that accuracy in reporting for FIFO, giving a more accurate picture of the balance sheet. So LIFO tax savings, FIFO better inventory management. So it's showing what the reserve would be from the tax reporting and the FIFO inventory amounts. Okay, to have a more accurate balance sheet. So that consistency reporting, once they choose a method, they can't frequently change. It needs to be like a really good reason. And they have to inform shareholders of the inventory method being used in a note to financial statements. And the key point here, FIFO kind of summary, most closely resembles actual physical flow. When inventory costs are rising, FIFO results in higher reported inventory in the balance sheet and higher reported net income. Conversely, LIFO would result in lower reported inventory and net income, reducing the company's income tax obligation. Whew. All right, watch it again, watch the other videos, read through it, look at the examples, maybe work on the homework problems that focus on this, really see it a few times, think about it a few times to let it sink in. See you in the next video.